or you can do it yourself.
Okay.
Whatever you want. Uh, Pretty big day again in futures. Big limit up move, right?
Yeah, lots of continued issues with the flooding, and I'm sure you saw Fraser put out a alert this morning.
Yeah.
Curtailments to mesh up with what they can actually ship, and then
It
the
was
CN basically is telling people that they're almost back to square one. Whatever progress they've made over the last 2+ weeks with the continuation of these torrential rains, they basically had 2 or 3 washouts again, where they're almost back to square one as far as all the infrastructure that they replaced. They basically are starting over here.
really, it's I haven't been paying attention to the weather out there, but
Yeah, they're getting dumped on again today, and then there's another big system that's going to come in. I think the end of this week into the weekend, where they've just been getting deluged. Every 2-3 days they get these big storms, and it's just it's not nearly the volume that initiated all this flooding, but it just hampers all the efforts to kind of reopen roads and the rail lines.
yeah, no doubt. I thought Wes Fraser's message was a little cryptic. They didn't give you any specific numbers of
Right.
what they were, which is probably because they don't really know. Um, and from what I read into it, it's probably a pulp issue more than anything.
Yeah. I think that's there's big issues going to the port of Vancouver right now, where basically they can't get anything into the port of Vancouver, and the inability to get stuff off of vessels, onto vessels, and get it out of there is hampering, efforts to where, from a logging standpoint, I don't think there's any disruptions to logging in the north. I think if there's any issues, it would be in the southern interior of BC. But it's the logistics of getting rail car allocation. I think conservatively, southern BC mills, all BC mills probably are getting somewhere in the neighborhood of 60 to 75% rail car allocation. And
Right.
so, what's the point of producing? And I think you'll see Canfor. I think you'll see Talco. I think you'll see all the majors kind of follow suit in BC. Where, look, if we're only going to get 70% rail car allocation, then let's take our holiday curtailments early. Let's just let's go to 3-4 day work weeks through the end of the year until this cleans itself up.
Well, and we've proven that when everything's running just perfectly, we
Yeah,
still probably just barely have enough wood available.
yeah,
Yeah,
yeah.
any little blip is not good. All right, well let's get the show on the road here. It is the last day of the month, and to highlight a little bit of what we're going to talk about. It is expiration for December options. That's just a little foreshadowing. But let's take a look into where we missed last week. So let's take a look at where we were at.
Yeah, a lot's happened here. So you can see on this chart, Mike, I just put a January daily, and this is as of this morning, so this doesn't even reflect today's limit up move in Jan. But the last time we spoke was on the 16th of November. November futures had just expired at 566. January at this point in time was $650. I think you made the all telling call that we're either going to break out one way or the other. And sure enough, we had a massive breakout to the upside. So what a difference 2 weeks makes. And that 2 weeks ago, we were $650. Today, we're limit up here at 824.50. So a pretty sizable move breakout to the upside.
Yeah, I think what's really important to highlight here is on the 15th of January, or I'm sorry, on the 15th of November, all eyes basically were on that November futures contract and where it was going to expire or turn into a cash product. Then the next day you come in, and while we're still living in the present and dealing with day-to-day needs for lumber, the futures represents a car that's going to ship in January. It's going to ship late January. It's not arriving till February. So futures is an important tool, but we have to remember from a forecasting standpoint, it's a different time horizon. So the market absolutely changed kind of almost overnight, where on the 15th, we expired kind of weak. Everyone thought everything looked as though we were going to have a pullback, and then, or a continued pullback, I guess. And then all of a sudden you open up on the 16th and off to the races, because you're talking about something that, this is product you're going to be using in the spring.
Yeah. And I think, as we progress through these charts, and again, basically, we're going to do a recap of the last couple of weeks from just a chart standpoint, a basis standpoint, open interest, and then we'll jump into options here. But as we progress through these, you can see, again, this is the basis as of November 15th. Again, cash was at a $73 discount, or futures was at January was at a $73 premium. If you jump forward to the next slide, you can see now, and again, this is as of this morning, we were $124, and the reality is this is probably somewhere in the $135 to $148 area, and that's based upon kind of the low end of the cash market is a 680. West Fraser is still a 680. Everybody else seems to be in the 700 to 740 area, and then you've got January up at 824. So you've had another push out of the basis.
Recap. This represents you could buy cash today for somewhere $125 to $140 underneath where the futures price is trading.
Yeah. Yep.
So futures right now we're limit. There's a little bit of a pool. 824.50 bid. So you could sell a car, 2x4 random Western Spruce delivered, or FOB Prince George, British Columbia, 824.50. And we're thinking we could probably buy cash today, still around 680.
No, my guess is, again, this was best guess as far as what print would realistically be tonight. He lagged print woefully last week. So, again, the low end seems to be the 680 area. So my guess is print's going to be 680 to 700. If he wants to get aggressive, then he can look at some of the other mills in the 720, 740, 750 area. So it just depends on how you want to look at, and again, you'll see in some of these other charts that I added today, basis just isn't Western SPF. The basis relates to Eastern Great Lakes. It relates to hemp fur. If you scroll through, these are great charts right here. These give an historical basis perspective, and what you're looking at there is, again, historical weekly cash prices on Western SPF 2x4s versus front month futures. So from an historical perspective, this $120, $150 basis is a massive basis opportunity. And at the very least, this tells us that cash is still the best buy, futures is still the best sell. So from a production standpoint, these are phenomenal opportunities for the mills, for producers to build legitimate order file at substantially higher numbers. Even though cash is appreciating here, you can still capture significantly higher numbers using futures to build legitimate order file. And the other thing that I'll point out here, Mike, is that when you look at this time frame right now versus a year ago, when we were under this same kind of scenario where prices started to creep up toward $1,000, the structure was completely different now versus a year ago. A year ago, you had normalized basis where cash was leading futures or even money with futures. So now you have futures driving this rally. So at the very least, look, I might not trade futures, but I want to at least look at this to realize that if I'm going to buy something, cash, when it comes to Western SPF, when it comes to Eastern Great Lakes, when it comes to hemp fur, when it comes to some of these other species, is still the better buy relative to futures.
Yep. And just for perspective, at the high points here, the cash price, if you go to West Fraser to buy a rail car lumber, is going to cost you more than what the futures price is. At these prices down here, the futures is higher than what the cash price or the West Fraser price is. All right, let's roll through a couple more Here's
And so that's
Eastern.
just that's Eastern Great Lakes 2x4s. You can see that same basis relationship again this year versus last year. Next one is just Hemfir, and then the last one is Southern Yellow Pine. Southern Yellow Pine's a little bit more normalized from where it was. You know, back in the summer, you had ample opportunity to buy Southern Yellow Pine at a massive discount, and you know that's kind of been altered now back to normalcy there.
All right. So let's scoot back and just look at some of the well, you had March up here.
Yeah, so there's March, and again, you can see the November. I just, you know, put November 16th as a reference point, and again, March today traded as high as 822.40. So you know you're substantially higher than 2 weeks ago, and from a basis standpoint, let's see here. If you can see March basically is traded up into or close to the Bollinger Band high, that red line today. And then that next chart, Mike, is the March basis from 2 weeks ago at about $136. And then as of this morning, you were about 123. So, you know, the question is, well, wait a second, why did that January basis move out from 2 weeks ago? And why did the March narrow in? If you look at the next chart, which is the spread relationship, this kind of tells you why. 2 weeks ago, that Jan-March spread, January was trading somewhere in the neighborhood of $17 under March. Yep. As of right now, January's trading about $15 over March. So January has seen a significantly greater move higher than March. January's basically gained almost $32 over March in this 2 week time frame. So, you know, that being said, this is why it's important to understand the spread relationship between the different contract months, because depending on the spread structure, you're going to get more bang for your buck, or you're going to have more risk depending on whether you're long or short a front month versus the back month.
Yep, that's this is great information right here for sure. All right, let's the continuation. You know, one of the things I'm watching is we kind of have a bit of a little double top here. I'm also interested that today we went, you know, and we are limit up right now in January, but March doesn't have a limit, or did not go limit up today. So if this was, you know, screaming strong, we would definitely have limit across the board, limit up moves. It's just something to put in, you know, another data point there that you can still buy.
No, and I agree that it's interesting. January is getting all the love here the last kind of week, and March seems to be lagging behind, where you would think that at the very least from a spring standpoint, March would be seeing just as much love, because that's the actual consumptions, you know, from a consumption standpoint, that's when you're going to be conceivably taking delivery of lumber futures for your spring needs.
Right. And, you know, one thing I always look at, people look and say, oh, you know, January's limit up. Well, you can still actually buy a January contract right now. If you buy a March and then you go into the spread market and you buy a January-March spread, that effectively takes your March contract and turns it into a January contract. So right now you could buy January around $830.
Right.
So
right.
About $6 over the
yeah, no, that's a great point, in that people think when a market's limit up or limit down, you know, through the spread structure, and then also through something that we'll get in at some point, the synthetics of using options, you
Correct.
do have ways to neutralize a position or get into a position if you can't do it necessarily in the outright futures.
All right, let's take a look at some of the stats. Here is the open interest back on the 15th, and we had 1,600 contracts. And then, we go to today. We're up to 1883. So we've picked up almost 300 contracts. That's usually what that tells you, is there's more interest in being involved in the market. So that's a good sign for the current, it confirms the current move.
Yeah, I think when I look at this structure right now, the reversal of that Jan-March spread going from a negative structure to a positive structure, going from a bear spread to a bull spread, and then I look at this build and open interest. These are kind of the fundamental things that you look as far as fundamentally you're getting confirmation in some of the technical the numbers that we look at in trading futures that give fundamental justification for what we're doing here. As far as, look, if we were up here and open interest was falling, that's a pretty bearish indicator. The fact that we're building open interest here is fundamentally important to justify this move.
So here's the commitment of traders report. The thing I look for in this is the ratio of long to short in the producer merchant users and in managed money. So, you know, these are hedgers, these are speculators. We're kind of even right now. There's not, you know, there's nothing. The thing that jumps out at me on this is that there's nothing really to jump out at me.
Yeah, and if you jump forward to the next one, and that'll be as of the 23rd here. So you'll see that the one thing that jumps out here, you have an increase in producer shorts. So that's an indication that you're probably getting some producer, some mill type selling. And then the other one that jumps out is look at that big change in the managed money. Yep. Where you've had the longs increase, the shorts decrease. You know, that's almost a 335 car swing. So again, you've got the momentum traders, you know, hedge fund, I'm sorry, the commodity fund type momentum traders in chasing the strength in futures. You've got producers, you've got the mills kind of fading that strength. But the important takeaway here is that increase in open interest. You know, that becomes an important thing to justify this move.
Yep. So, you know, what you could say is that the speculators got long.
Yeah. Yep. Finally.
Yes. And the mills sold into, well, the hedgers sold into it a little bit.
Yeah. I think hedgers, again, when you look at that basis, those basis charts, it presents a unique opportunity from an inventory hedge standpoint and from a producer hedge production hedge standpoint where, okay, we're long cash. We can lay off some of the risk in a big premium in selling futures.
All right. So then overall open interest, as we know, is historically very low right now.
Yeah.
All right. So now the topic of the day, options 101. And I think what's going to happen here is we're going to probably call December options month. You can't cover all of this in one day. That is for sure. For those of you who are a little more well-versed, we apologize. We're going to go pretty remedial on this. So, you know, let's first off just define what an option on a futures contract really is.
And you know, the one thing I'll add to that, I know we're doing options for the novice. As we progress through options this month, we will get into much more detailed analysis strategies to where I think this will be a good crash course, not only for people new to options, but also people that do use options as far as why you would use options, and then ultimately option strategies that you could tie into your risk management program. So that will happen as we evolve through this.
All right. So futures, we know it's a legally binding contract to make or take delivery at a point in the future. It's just that simple. Now, an option on a futures contract is basically what it just said. You have the option or the right to exercise or to turn your option into a futures contract if you are the buyer. If you are the seller, you are obligated to, if the buyer chooses to exercise the option, to enter into a futures contract with the counterparty on that option.
Yeah, no, correct. And I think you'll see in this next slide, you know, it kind of, you know, again, the buy side conveys a right, but not an obligation. I have the right, and from a risk standpoint, the buyer of an option, their risk is defined. So that's the one critical thing here, whether I'm buying a call option or a put option. And a call option is my right to be long something. A put option is my right to be short something. But that right designates there is a defined risk. So whatever I'm going to spend on that option, which is the option premium, that's my risk. So the buy side has defined risk, whereas the sell side, the writer of the option, has defined profit, and they theoretically have undefined risk, unlimited risk.
Correct. So, in our personal lives, you may not even, most people don't even realize it, but when you buy insurance on your car, what you're really buying is an option. You pay a premium, and then if your car is damaged, a crash, whatever, you have the right to go to the insurance company and say, okay, my car got damaged, I want you to fix it. But if the car doesn't get damaged, you cannot exercise that right, but you still pay the premium. So your risk when you're buying car insurance is the price of the premium that you're paying.
Yeah, I think that's the simplest way to look at it, in that we all own some form of insurance, whether it's homeowners insurance, renters insurance, auto insurance, and it's a sad day when you collect on that insurance.
Yeah.
So the idea of buying an option, you can look at an option as you're buying some kind of risk insurance, and it's a sad day when you collect on that insurance. And then the flip side of that is that, well, for everybody that's buying that insurance, that option insurance, the other side, there's an underwriter of that insurance, and they're collecting on that premium. So that's kind of why somebody would be buying an option. That's why somebody would take the counterparty risk, the other side, and write the option, sell the option.
So I'm just sitting here, I'm kind of thinking, I've never looked up why they have buy options, why they call them calls, and why puts are called puts. Maybe next time I'll do some research.
From my series 3 days, I always remembered the way I always would tell the difference is you call up and put down. So call up the market, I think the market's going higher. Put down, I think the market's going lower.
Okay. So a call is simply the right to buy. A put is simply the right to sell. All right, let's jump to the next one. All right. Now this is really important, and we touched on it just a little bit ago. If you are the buyer of an option, whether it's a call or a put, you control whether to exercise or to change that option into a futures contract. So if you buy a call, you have the right to buy futures. If you sell a call, you have the obligation, if the buyer decides that they want to take that call option and turn it into a futures contract, you have the obligation to take if it's a call, you will sell a futures contract to the buyer of the call, the buyer of the option. So buying and selling, also we call it long, means to buy, short means to sell. So if you are long a call, you have bought one. If you are short a call, you have sold one.
Yeah, and the other thing that I'll just like a futures contract, Mike, you do not know who the other counterparty is. This is an unknown counterparty. It's simply when I go to buy a call, there's somebody willing to sell it to me. I don't know who that other person is. I don't know what their motives are. I have my, whether it's risk insurance, speculation, all of the above, somebody's got that opposite perspective, but you're never going to know who that counterparty is, even if it's exercised. So the long side of an option, whether I'm buying or a call or buying a put, has the ability to exercise the option. The short side would be assigned the option. And so the buy side can exercise an option at any given point. It doesn't have to be in the money, and we'll get into what in the money is, out of the money, and all that shortly. But the buy side of an option always has the right to exercise that option, even if it's not in the money. So even if the option strike price is a mile away from where the current market is, they always have the ability to exercise that. On option expiration day, the CME, the clearing exchange, will auto exercise that option if it's in the money. If it's at or in the money, it gets auto exercised. And then the other side of the transaction, the other counterparty that short the option, they get assigned the option. So if I'm long, let's say that I was long a January 800 call, long a December 800 call. January is going to close realistically at 824.50 today. I would be long a December. That December call at $800 would be converted into a January futures long at $800 plus the cost of the option. So let's say 3 weeks ago, I bought a January 800 call at $5. I would be auto exercised with the market closing above $800. I would be long January futures at 805. The other side of that, the person that wrote the option would be assigned a short position at 805.
So let's go through a couple of the components of the option. I'm actually going to start at the bottom. I think this is important. The premium. Options are not free. There's no such thing as a free lunch. So when you are a buyer, you have to pay a certain premium or an amount of money. When you are the seller, you get to collect that money. You actually get paid no matter what. You will always get that money. So let's take a quick look here at the money. January options, fair value is around $50. Call it, let's say $55 for a January call. So if you wanted to buy an 825 option today, you would pay $55. That money leaves your account immediately and it goes into the account of the seller. And that transaction is finished. As soon as you buy the option, your money leaves your account, and the seller of the option, if you sell it, that money goes into your account. So then we move up to the next thing, the expiration date. Options have a lifetime or a life cycle to them. So currently, we were just talking about January January options have about 32 days left until that contract expires. So that's an important distinction about an option. It doesn't just hang out there forever. Whereas if your grandparents bought Ford stock back in the 1940s, they could still have that Ford stock today. There is no expiration to an equity, a stock position, but an option position, it has a life to it. It will expire. And then I think the most important thing is the strike price. And this is the actual price of the futures contract that you will be entered into upon conversion. So let's take a quick example here. If you were to have bought, or you were to buy a January 800 call, so that means you have the right to buy January at $800. Today, the market is trading, $825. You could exercise that option and you'd be given a futures contract. You'd be long one futures contract at $800. So you would already have profit built into that futures position. The underlying contract is obviously we're talking about lumber. And then there's the buyer and the seller. So there's a lot of misnomers about the risk on options and what it actually looks like. So let's cover that real quick, and then we'll wrap it up with that. So if you buy an option, what's the most you can lose?
Yeah, so I think this is a great point, Mike, in that the buyer of an option, the most that you can lose is the cost or that premium of the option. So whatever your cost is up front, that's the most you can lose on that option.
So if you were going to buy an option today for January 825 calls, that's cost you, somewhere around $55. What that works out to about $6,000. your maximum exposure, your maximum loss would be $6,000. Well,
And the other thing, yeah, and the other thing I would point out is that, okay, so these January options go off the end of December, so you have 31 days to expiration. So the idea that there is a significant premium attached, okay, I can't, we're lock limit up. I can't buy January now at 825. If I wanted to use futures, it would cost me $55. It gives me the right to be long at 825, but your net cost is going to be that 825 strike price plus the cost of that option. So for this to make money, for this to break even, if you were to hold this through January expiration, the end of December, the market has to get to 825 plus the cost, the premium, the cost of the option, so that's your net break even point price at that point. That's your net break even at that point.
correct. So now if you sell this option, if you're the seller of it, the most money you can make is $55. So you could, and that goes right into your account. But what you could lose is, basically unlimited, because if you sell a call and the buyer exercises it, you are going to get entered into a futures contract, and we know that the risk is basically unlimited on a futures contract, especially the longs, if you sell a futures contract.
Right. And so the flip side, the person that's writing this option, the seller of this option, okay, they'd be selling an 825 call, they'd be collecting $55. So the net effect, their risk would be anything above 879, 880. At that point, they have unlimited risk above the option money that they're collecting. So if they were to hold this through expiration, anything above 879, then it would be dollar for dollar risk.
Yep. So, at first glance, you'd be like, well, heck, why would anyone ever sell an option? But the reality is it can be a very good, profitable way to make money.
And I haven't seen the current statistic, but I know for years, I think it's something like, at least when it comes to options and futures, something like 92% of the people that buy options end up losing money because of that expiration date, that time decay, the premium cost going into that expiration, the time decay, where the vast majority of money is made on writing the option, because every day this asset, as it gets closer and closer to expiration, is an eroding asset. The time decay, the time value of the asset. And again, this is stuff that we'll cover in later podcasts, but there's a reason why that statistic bores out, because if I'm buying an option, time is not on my side. I need the option to move in my favor, the sooner the better, so that option gains in value. If I'm writing an option, time is on my side.
Correct. All right. So we're going to wrap it up here. Let's just recap real quick. This is the slide. If you walk away from anything today, here's what you need to walk away with. Calls. Calls are the right to buy. Puts are the right to sell. And then the other thing I think you should walk away with are these three definitions. The strike price, very important that you understand what that option will turn into if you decide to exercise it. It's going to turn into a futures at the strike price. It's very important to understand how much time you have to actually exercise that option. And then, what's the premium? That's where kind of the analysis and the opinion comes in. Is it a good value or a bad value? So walk away today. Calls are the right to buy. Puts are the right to sell. Strike price is where the option exercises, and that's the futures price it turns into. Expiration date is how long you have to make that decision, and premium is what you're going to pay for it. So with that, let's sign off. Greg, thanks so much for bringing this great information to us today. And we will see everybody next week, and we'll go a little bit deeper into options.
Yeah, looking forward to it, Mike. Thank you so much. Have a great day.
All right. Take care, everyone. And